Banks act as financial intermediaries because they stand between savers and borrowers. Savers place deposits with banks and then receive interest payments and withdraw money. Borrowers receive loans from banks and repay the loans with interest. In turn, banks return money to savers in the form of withdrawals, which also include interest payments from banks to savers. The net worth of a bank can be calculated using a simple equation known to most accountants. Assets equals liabilities plus net worth. Let's discuss the main types of assets that a bank has. First, loans. Loans are accounts receivable from borrowers. U.S. government securities. These are investments that can be converted to cash. Reserves. This is a bank's bank account with the federal bank. The main liability of a bank is its deposits. The deposits are accounts payable to lenders. The deposits are the lender's claim on the bank's assets. If we subtract the depositor's claims on assets, then we are left with a bank's net worth. The net worth is the bank's own claim on its assets. Some of the most influential decisions regarding monetary policy in the United States are made behind the doors of the Federal Reserve Bank. The Federal Reserve, also known as the Fed, is governed by a board of governors who are appointed by the President of the United States for 14-year terms. The purpose of the Federal Reserve is threefold. First, the Federal Reserve conducts monetary policy. Second, it promotes financial system stability. Third, it acts as a bank to commercial banks and the federal government. Let's discuss each of these roles in more detail. Monetary policy is carried out using any of these three things. Open market operation is a tactic that the Fed undergoes to manipulate the money supply and control inflation. It does this by either selling or buying U.S. securities on the open market. In the case of selling bonds, this will pull money out of the market. On the other side, if bonds are purchased by the Fed, then the money paid for its own bonds are put back into the economy. The Fed can also impact the interest rates in the open market through the interest it pays on its securities. The Fed regulates other lenders in the economy by requiring that a certain amount of reserves be kept and not lent out. By requiring banks to have more reserves, a restriction on the money supply is created and may slow the economy. If the Fed requires lower reserve levels, then more money is lent, and this money cycles through the economy. The Fed rate, or overnight lending rate, is what the Fed charges other banks to borrow money from it. If the Fed changes this rate, then banks will alter their banking to preserve reserves and borrow less from the Fed. They will also adjust their own lending rates to pass the burden on to the rest of the economy. This has a slowing effect on the economy because money becomes more expensive. The following two examples show the impact of open market operations on the banks and the money it loans. The top T account shows a bank's original balance sheet. The central bank, or Fed, buys bonds back from the bank. This raises the bank's reserves. It also lowers the bonds in its assets. On the bottom, we see that the bank can now lend these additional reserves out to borrowers. This boosts the economy by putting money in the hands of either investors or consumers, who are the borrowers. Either way, GDP will rise. Next, we see the Fed selling bonds to a bank. The top T account shows a bank's original balance sheet. The central bank, or Fed, sells bonds to the bank. This lowers the bank's reserves and increases its bond holdings. On the bottom, we see that the bank cannot lend as much as it used to. This shrinks the economy by taking money out of the hands of borrowers, investors, or consumers. Either way, GDP growth slows. Let's move on to the Fed's role in promoting financial stability. During the Great Depression, there were many people who rushed to take their money out of the banking system. This run on banks can lead to the disintegration of a banking system, especially when sufficient reserves are not on hand. To solve this, the Fed has required reserve amounts for banks. In addition, the Federal Deposit Insurance Agency was also created to insure depositors' money. The Fed also acts as the lender of last resort to banks that are under financial stress. The final role that the Fed undertakes is to provide banking services to commercial banks and the federal government. As previously discussed, the Fed lends funds to banks and sells government debt. In this graph, we see the original equilibrium occurs at EO. An expansionary monetary policy will shift the supply of loanable funds to the right from the original supply curve SO to the new supply curve S1 and to a new equilibrium of E1, reducing the interest rate from 8% to 6%. A contractionary monetary policy will shift the supply of loanable funds to the left from the original supply curve SO to the new supply S2 and raise the interest rate from 8% to 10%. The economy is originally in a recession, with the equilibrium output and price level shown at ER. Expansionary monetary policy will reduce interest rates and shift aggregate demand for money to the right from ADO to AD1, leading to the new equilibrium EP, or E1 in our graph, which is at the potential GDP level of output, with a relatively small rise in the price level. The economy is originally producing above the potential GDP level of output at the equilibrium EI and is experiencing pressures for an inflationary rise in the price level. Contractionary monetary policy will shift aggregate demand to the left from ADO to AD1, thus leading to a new equilibrium, EP or E1 in our graph, at the potential GDP level of output. In expansionary monetary policy, the central bank causes the money supply and loanable funds to increase, which lowers the interest rate, stimulating additional borrowing for investment and consumption, and shifting aggregate demand to the right. The result is a higher price level and, at least in the short run, higher real GDP. On the bottom, in contractionary monetary policy, the central bank causes the supply of money and credit in the economy to decrease, which raises the interest rate, discouraging borrowing for investing and consumption, and shifting aggregate demand left. The result is a lower price level and, at least in the short run, lower real GDP. Through the episodes shown here, the Federal Reserve typically reacts to higher inflation with a contractionary monetary policy and a higher interest rate, and reacted to higher unemployment with an expansionary monetary policy and a lower interest rate. Velocity is the nominal GDP divided by the money supply for a given year. Different measures of velocity can be calculated by using different measures of the money supply. Velocity is calculated by using M1 and has lacked a steady trend since the 1980s, instead bouncing up and down. In a neoclassical long-run view, monetary policy affects only the price level, not the level of output in the economy. For example, an expansionary monetary policy causes aggregate demand to shift from the original ADO to AD1. However, the adjustment of the economy from the original equilibrium O to the new equilibrium E1 represents an inflationary increase in the price level from PO to P1, but has no effect in the long run on output or unemployment rate. In fact, no shift in aggregate demand will affect the equilibrium quantity of output in this model.